Hi there, welcome to The Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from the newsroom. Algoma Steel and a major South Korean shipbuilder, Hanwha Ocean, have signed a memorandum of understanding valued at more than $340 million. The Ontario steelmaker would use the cash to develop a structural steam beam mill. The deal is contingent on the South Korean company winning Canada's military contract for a new fleet of submarines. Algoma is one of more than a dozen Canadian companies partnered with to provide technology for subs for the Royal Canadian Navy. Shares in General Motors up about 4% in the pre-market. The automaker is forecasting profit growth of as much as $2 billion and has increased dividends and buybacks. The move is fueled by demand for new and pricier models. A non-restrictive regulatory environment under U.S. President Donald Trump is also helping lift profit growth. GM's new guidance rests on selling more of its largest trucks and SUVs and fewer electric vehicles. And shares in UPS also up in the pre-market. The giant shipper forecast full-year sales above analyst estimates. The company now projects more than $89 billion in revenue, coming in more than $1.5 billion over projections. The outlook comes as UPS works on a new profit-boosting plan, which has seen it cut deliveries from its largest customer, Amazon, citing that business as not profitable enough. U.S. futures generally pointing higher in pre-market trading. Let's have a look at the TSX, which has been accelerated this week by higher gold prices. It lost a little bit of altitude yesterday. And let's have a look at our dollar, the Canadian loonie this morning. And first, are we going to do oil? Sorry, control room. They don't call me the confuser for nothing. There is the Canadian dollar. You can see marginally higher once again against the US dollar, north of 73 cents. Not great for exporters. But let's have a look now at oil, which, of course, gyrating as usual amid geopolitical fears. It has been rallying pretty sharply. We've heard confirmation from Bloomberg that OPEC is likely to stick with its production freeze in the first quarter, i.e. no increases. And let's have a look at gold. Finally, it's been a dramatic story for more than a year. And there you have it, down a little bit right now, but in record territory, above $5,100 US an ounce. And finally, Bitcoin, the much ballyhooed alternative to gold, has been heading downwards, suffering again today. Let's start off here with gold trading near $5,100 US an ounce. It's just incredible. It's gone parabolic, as they say, ballistic to the upside over the past couple of weeks. Our guest says the market may be underestimating the risk of a correction in the precious metal and other metals. We're joined by Tim Regan, Managing Director at King West & Company. Great to have you.
Good to be here, Andy.
Maybe we could put up a 20-year chart for gold, because I'm a bit like a broken record on this one, but It hit a record high in 2011 and then really did nothing for almost a decade. So we've seen this movie before to some extent.
Yes, I mean, when you look at gold today, what drove it last year, you did have some central banks buying. I think central bank buying was up about 25%, mainly emerging markets like Kazakhstan, Poland, Brazil. But there's a lot of speculation now in the market. And gold seems to be at the forefront of that speculation. We've seen Bitcoin come down a little bit, and we've seen this story again and again. And so, where is gold going? We're hearing 6,000, 7,000, and as Mark Twain once said, it's not what you don't know, it's what you know for sure that ain't so that gets you into trouble. So I think gold is, will it correct? I don't know, but I wouldn't want to bet on it to go up the way it did last year.
Yeah, I mean, it moves. How does it move? I mean, it's not a normal commodity because the vast bulk of it has been sitting above ground since the pharaohs and before produced it.
It's been a speculative asset for 10,000 years, and that hasn't changed.
Yeah. I know there's some historians who say getting gold and silver was a fundamental reason for the Roman Empire.
Roman Empire, the Spanish coming to the New World, everything. And, we talk about gold, silver. Silver's been fantastic.
Yeah.
I think the Hunt brothers are rolling in their graves.
Oh, my goodness. Let's have a look at silver because that chart is truly dramatic. And it's interesting. RBC is highlighting some companies that have, at these prices, big exposure to silver, including Wheaton Precious Metals. Their roots were in silver. Then, of course, they diversified because silver mines are hard to find. But they have something like 50% of their revenue now tied to silver, apparently.
Well, it's incredible, the price, because the price didn't move. I don't know if you have a longer chart for decades upon decades.
If you will try a 20-year, sorry, go
sure.
on.
And now you're looking at 250% in 1 year. I have heard of people who are now going through, mom's silverware drawer to see if they can melt it down.
Yeah.
I'm not even kidding on that one.
No, that's interesting. We should get in touch with a couple of these places that buy precious metals because historically we've seen that. People resort to melting stuff down.
So it's been an incredible run. But when you look at that and you talk about your parabolic arcs, I've never seen one as dramatic as that one.
That really says it all. We need to resort to logarithmic charts here to give a better idea.
Absolutely.
Because it kind of exaggerates the percentage move there.
Absolutely. And so, fundamentally, these commodities do have industrial uses. We have gold that backs a lot of, the central banks. They're moving away from the U.S. dollar more into gold. But the dramatic rise really doesn't make that much sense.
What about crypto? I like to joke that it's the criminal's friend, the money launderer's friend. I'm sure not everybody in the crypto industry likes to hear me say that, but is that kind of a busted flush for now?
Well, I mean, I don't know. You look at crypto, you talk about money laundering. I've heard it also finances terrorism, arms deals. There's, how do we say that? There's a lot of that goes on in the world. But yes, I mean, in my opinion, but crypto still thrives and survives.
How are you playing Canadian stocks right now? Is there a group you think is being unfairly downvalued by the market?
Yeah, there are. We think financials can still run. We have a big weight in financials. In our portfolio, we're looking for things that have faster earnings growth in the market, higher return on equity, and are also cheaper. And when we do that and look at that type of portfolio in a speculative market, it's quite a bit more resilient. And over time, it will come through.
You have some stock ideas for us. You say that we should be wary of a correction in metals, but Lundin Mining stands out for you right now.
Lundin, we bought a small position. It's done very well for us. It was more about their copper mine coming on stream in the future and how cheap it got. And so it's done fairly well, Lundin. That's the only materials.
LUN, yes.
Yes, that we will own, that we own today. And so, I'm not speaking out of both sides of my mouth. We do want to buy stocks that go up, but we are, even Lundin today, we're, seeing how much more can we get out of this stock in the next 6 months. So.
And you're talking about their big potential mine. I think it's in Chile.
Yes, yes. And that's years away. But as you can see, down in April, May, the stock was very low.
Yeah.
And it's run quite a bit. So it's been a good one for us.
You have another idea for us, Amrize, AMRZ in New York. I haven't heard of them. What do they do?
Amrize it's a great company. What do they do? The core of their business, people will remember as Lafarge North America. They're mainly aggregates. So Lafarge was bought by Holcim, a Swiss company. And now they've spun it off in North America. So it's all the aggregates. They're one of the biggest aggregate producers. And they also have a roofing business as well. This company is about a $30 billion business. But we think it's a fantastic business because if you're going to grow infrastructure, everybody needs that. And it trades fairly cheaply because it was spun off in Switzerland. The person who ran Holcim in Switzerland actually quit there, put his own money in Amrise, and is now running Amrise with his own money. So we like to see good management that actually is committed to the company that they're running.
Tim, thank you very much indeed.
Thank you.
Tim Regan, Managing Director at King West & Company. Coming up, an increased GST rebate is drawing criticism. Some critics are calling it a temporary fix to address a much bigger problem. We'll be right back. The Carney government announced new affordability measures yesterday, including an increase to rebates of the goods and services tax for moderate and lower income Canadians. It's part of a suite of affordability measures. They're putting more money into Canadian food producers, for example. We are joined by CTV's Scott Hurst. Scott, just remind us, what will people with low and moderate incomes be getting here with these increased rebates?
Andrew, good morning. The Prime Minister said this will impact roughly about 12 million Canadians. So we can break down ultimately what this might mean for your bottom line. And as we know, so many of us go to the grocery store and often are left looking at the bill, wondering how it all adds up so quickly. And the big question, where does all that money go? So let's break it down according to the Liberal government, saying 12 million people will benefit taking the GST credit and raising it by 25% for 5 years, plus a one-time payment this year. And by their numbers, that means the average family of four will get back nearly $2,000 this year and about $1,400 each of the following years. And for a single person, that could mean just shy of $1,000 this year. Carney is calling the affordability measures a boost now for families and a bridge to longer-term food security and affordability, with other money towards strengthening domestic food production and improving access to nutritious food, Andrew.
Right, and I think you were talking about the entire GST credit there that families and individuals get. But the opposition, it's their job, is saying that this is not going far enough.
Well, one of the big announcements from the opposition, or the big arguments from the opposition, is that this was a big, flashy announcement for not a whole lot of money back for families. The Conservatives, as we've seen through much of last year in Parliament as well, have been hyper-focused on affordability, trying to hold the Liberals to that. As they're saying, the Prime Minister himself said he should be judged on grocery prices. But the Conservatives say that they will allow this measure to pass, but are adamant no additional spending be attached to it, calling the plan really nothing more than Trudeau-era recycled policies, Andrew.
Oh, my goodness. Thank you very much, Scott. I really appreciate it. Scott Hurst, our colleague at CTV News. Coming up, we're going to hear about that Italian food marketplace, Italy. It has big growth plans as a top 60 locations worldwide. With more than 60 locations worldwide, Italy is expanding its North American footprint. In fact, North America is the largest market for the Italian food hall, provider of cooking lessons, etc. We got perspective from Nicola Farinetti, chairman of Italy, who spoke to our Bloomberg partners at the Asian Financial Forum in Hong Kong.
It was important here because we opened 13 new stores and we reached the 70 number of stores mark. We are now in 17 different countries, 3 continents. Most important number, more than 5,500 employees. I mean, we're discussing a company that was a family, small startup in Torino only in 2007. So we're pretty excited to export this Italian way of living through food all over the world.
Okay, and in terms of overseas markets, currently, of course, the footprint is mostly in the U.S., but of course you have a number of stores around in the Asia Pacific.
Roughly 50% in North America, U.S. and Canada, 40% in Europe, and the rest 10% 80% goes between Middle East and Korea and Japan.
Right. Do you have any priorities between those markets this year?
Well, North America, it's the country where we see we have the most potential. We're already there. We have so many grounds still need to cover, and it's easier to develop for us right now. But we're looking at the world. It's a very specific moment in time, and we're looking at any opportunity that we really feel fits our brand and value.
Now, I want to ask you too, because a lot of people are trying to figure out the state of the U.S. economy and really consumer appetite, literally and figuratively, for example, in your case. How would you describe demand in your U.S. stores? And also, I want to understand cost pressures too, because people talk about inflation every day, and I wonder how you're feeling that.
I think in U.S. we're seeing actually what we're seeing more or less across the world. Usually in U.S. just happen faster and earlier.
Yeah.
We're seeing a shifting between sit-down restaurants to more quick service, fast-paced F&B or deliver retail at home, maybe pre-sized, pre-cooked, ready to be eaten.
Okay.
I guess it's a combination of diminishing power, higher pricing, and also this willingness of convenience and fast pace that we keep requiring nowadays. Right. So I guess this is the shifting that we're seeing the most in the U.S. The demand is there. We're doing very well. We're very happy. But clearly today you need to watch the market every day to understand what's the next step should be.
And what do you think is the most important consumer trend you've noticed across the board as you travel and look at your different businesses?
I think that's the one. In fact, last year we opened our first called Italy Cafe. We did 3 in New York.
Okay.
It's a very small Italian coffee bar, 200, 300 square meters, where everything is incredibly fast, super high quality, and you can go from breakfast all the way to early dinner, from cornetto, cappuccino to salad, pizza, you name it.
That quick, huh?
And people do not want to lose quality, but they want to spend a little less than they're used to, and I think this format is killing it.
And I guess from a financial perspective, intuitively, I just think it's better that there's quicker turnover, and the less time people stay in your stores, probably the better. But how do you approach it? Because people want convenience and they want things quick.
Look, our format is very resilient, right? But because when we look at our flagship, we have retail, we have sit-down restaurants, and we have quick service, we have events, and we have classes, all together under one roof.
Yeah.
So we are capable of moving the revenue through the year or through the months, now probably through the quarters, for what people are looking for. So we can explore more our retail opportunity, adding more tables in certain moment of the year. So it's easier for us than probably other businesses to adapt to customers.
Right, and clearly, the Italian offering is what you bring the most. And we were just talking about this. What among the ingredients or things that you sell do you source locally, and what are non-negotiables that they need to be sourced
for us,
from Italy?
Being Italian is about tradition, about recipe, and about the real products that really define our cuisine. Take wine or olive oil or Italian pasta. But in each country we go, we try to thank the country and be more sustainable and source an incredible amount of array of ingredients there. Like we make cappuccinos with different milk in each city that we go, because we want to partner with a local farmer. Right. The same truth is for a lot of vegetable, fish, meat, you name it. So actually when you go to look at our store, probably more than 50% of the product we consume are actually local.
How much have you set aside for expansion this year?
This year, we have confirmed so far 15 new stores. Right. Maybe a couple of more are going to add. And we're going to keep growing in this fundamental that we're seeing working. So we're doing a lot of travel retail. Okay. We're opening JFK. We're opening both Paris Airport. We're opening Milano Linate and Caselle in Italy. We're doing flagship in US. We're doing some new Middle East, 2 new in Jeddah. Last year we did Bahrain and Beirut. So we're going to keep pushing in all different aspects. Few new Italy Cafe probably that we cannot confirm. Okay. But we're excited. We're rolling. People like our brand. People like our food, and we need to keep pushing.
We can take advantage of that in Hong Kong. When do I get to see you guys at the Hong Kong airport? Since you mentioned travel, is that something you're studying?
We're studying. First of all, I love Hong Kong. Okay. I would love to have an excuse to come here much more often. Hong Kong is a difficult market for us because of real estate. We usually enter the market with a big flagship and finding...
Or the cost of real estate specifically.
The cost of real estate, but also the availability. Yeah, okay. It's very difficult to find a prime 30,000 square feet of real estate in Hong Kong where to put an Italian food flagship store, right? So we're looking at all our options. Eventually, I hope we're going to get here. But we're lucky we have many markets in which we can expand, and we can wait to find the right opportunities.
What about mainland China?
That's where we're studying. I'm going to Shanghai tomorrow, which I'm a big fan of. I would love to open in Shanghai. We're studying the market. We believe we're very close to be able eventually to announce our possibilities there. The reason why I really like Shanghai is because it's probably an easier way to truly understand mainland Chinese market, which is a ginormous market, rather than Hong Kong that we both know is more international. The number of products that you can bring is much larger. So it's kind of a different market.
And we can import, I believe, pineapples for free here. What's your take on pineapples and pizza?
My take on disrupting Italian food tradition is that everybody can do whatever they want, as long as they know that their recipe is not Italian.
Okay, let's just not call it that, right?
Let's just not call it Italian pizza, it's fine.
All right.
If you want to annoy a French person, point out that Catherine de Medici, who married King Henry II of France in 1533, brought culinary techniques to France, including olive oil, fresh herbs, and sauces. And she also popularized the use of a fork and tablecloths. So the French have a lot to thank Italy for. Let's have a quick look at futures, U.S. futures, before we open the market shortly. And there you have it. It looks like stocks are going to be up in early trading south of the border. However, JetBlue shares look likely to come under pressure. Investors not delighted by the latest results from the company. A wider loss than expected in the last quarter. I'm not sure if we have a chart for JBlue. There's JBlue. You can see it has been suffering, and the stock was down about 3% in the pre-market. Oh, and let's have a look at the US dollar, because the US dollar is sliding, or has been sliding. There you have it. There's the 1 year. Maybe we could have a look at a 5-year chart, because Bloomberg says that the US dollar has sunk to the lowest level in 5 years, or nearly 4 years. I beg your pardon, nearly 4 years. Part of that is due to strength in the yen, but also Bloomberg says unpredictable Washington policy making and questions about the Fed independence and US fiscal credibility are weighing on the greenback. And let's have another look at gold, which, of course, has been blasting to new records this week. And you can see slightly down, but look at, there's the April futures. The spot price of gold, though, right now trading in record territory, $5,065 US. We are going to have those opening bells next. And there you have it, opening bell action on Bay Street and Wall Street. At the NASDAQ, Cullinan Therapeutics is doing the honors. At the NYSE, it's gold.com. And at the TSX, it's BMO ETFs and Physicians Finance Canada. It is time for the first 15. And let's see how the big North American benchmarks are doing right now. In particular, the S&P 500, of course, trying to get back to a new record high. Yesterday, the S&P 500 closing just below 7,000, and it's up once again. Where is it? 6,964, still slightly shy of its record high on Monday, January 12th. And let's have a look at the TSX, which, of course, has been breaking its own records, and it is up very slightly in early trading, 33,122, slightly down from its record high close on on Friday of last week, but only a few points. Looks like it has a good shot of breaking a new record today. Some stocks that are on our radar, Metro. Let's start off with that big Canadian food retailer. And you can see it is down a little bit. Wow, the stock has corrected fairly sharply from August. It looks as though earnings were below expectations in the latest quarter. I'm seeing adjusted EPS of $1.16, down from $1.20, and it was hit by a breakdown in the freezing equipment at a giant distribution center. And also apparently stubborn food inflation squeezing profits as well. Let's get over to Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team, for a look at some U.S. stocks of interest. Jeff, thanks very much for joining us. What's the latest at Corning?
Yeah, my pleasure. Thanks for having me. Corning is the top performing stock in the S&P 500 this morning. Definitely one worth watching over the course of the day. It is rising as a result of a deal that it struck to provide Meta, the Facebook owner, with fiber optic cables. This is a $6 billion deal, and it will also include Corning building a new fiber optic cable making facility in North Carolina. So this is kind of another example of the stocks that are related to or adjacent to the AI trade and the data center trade. The expansion of data centers, the building of new data centers, is going to require a large amount of fiber optic cable. Corning is the company that makes them, and that stock is up very sharply. If you look at the longer-term stock chart on that, you'll see just how dramatically this stock has risen over the last few years with that AI and data center trade.
CoStar is a provider of information on the commercial real estate market, and it's facing pressure from an activist investor.
Yes, it's facing pressure. The stock has not performed at all well over the last few years. It is down 2% so far this year, at least before the open here, because it's now the second or the third top performing stock in the S&P 500. So it might be able to reverse its negative move on the year so far. But this stock has been kind of in a downward trend over the last couple of years. 6.1% it fell in 2025. It dropped 18% in 2024. So now you have an activist that shows up, Third Point, demanding a handful of changes, and it's sending the stock sharply higher so far this morning. 5% so far. Definitely another one worth watching. Third Point is a big name and potentially looking to churn that long-term underperformance around here.
And we're seeing more pain for investors in giant health insurers.
A lot of pain this morning. Yeah, huge amounts of red on the screen if you're looking at health insurance companies. United Health opened 16% lower this morning. Humana 17%. CVS is down 11%. Other companies that are worth watching: Elevance Health, Alignment Health. A number of these stocks are down by double digits. What has happened here is Wall Street Journal has reported overnight that the Trump administration is going to hold Medicare rates steady over the course of the next year, and that is really hitting kind of expectations for where these stocks will head. As I mentioned, these are double-digit moves across a number of stocks. It is worth watching the Dow Jones Industrial Average today as a result of this. As I'm looking at the screen, it's the only of the averages that is down. Health insurance companies, especially United Health, have a pretty large weighting on that average. And so, this is, you're going to see this show up in a number of different places today. The Dow Jones is one of them.
Thank you very much, Jeff. That's Bloomberg's Jeff Morgan. Coming up, we'll get the latest on earnings season as the results pile up. That's next. Fears over Greenland and a possible tariff war launched by the US against European NATO allies that don't toe the line, according to US President Donald Trump. Those have dissipated. And now the focus is on earnings. We are joined by Garrett Melson, portfolio strategist at Natixis Investment Manager Solutions. Garrett, great to see you. Thank you very much indeed for joining us. What themes are you looking out for in the current earnings season?
Yeah, well, I think time and time again, we see that corporate America can deliver, and they continue to drive solid top-line growth, and more importantly, I think, expand margins. And that's been a big reason why you've seen the resilience in markets over the last couple of years. And I think a big reason as to why you continue to see multiples grind higher, even though we hear all the time that markets are expensive. These are high-margin businesses, and higher margins and higher quality businesses demand higher multiples. So I think that's the underlying theme here. So far, it's still somewhat early in the season. We're just getting into the heart of it this week. Top line and bottom line beats are pretty solid, maybe a little bit softer than the prior quarter, but we did come into the quarter with pretty elevated expectations. You didn't see that typical downgrade or downward revision cycle to the same magnitude you normally did. So you could argue that the bar is maybe a little bit higher, but so far, you know, a lot of the reports we've seen have been pretty decent. The bigger point we're watching for, though, is the price reaction, and that's been fairly weak. Again, still kind of early in the season here, but something we'll be keeping a close eye on, as the reaction to the news generally matters a lot more than the news itself.
Sorry, you mean reaction to earnings surprises or projections, whether bullish or bearish?
Exactly. You know, it's the reaction to the news is what gives you a sense in terms of where expectations lie, what is actually priced in, and that's really the key to identifying opportunities in the marketplace here. So something we're keeping an eye on closely. I think the last I looked, we're at basically the weakest price reaction for double beats, so beating on the top and the bottom line since 2000. So again, it's still early, and you have to keep in mind we've been on a pretty solid run in here, certainly in the market pricing in this reacceleration narrative here domestically in the U.S. But again, you know, it gives you a sense as to what's priced in, and it certainly seems like a lot of optimism is already priced in at these levels.
We've heard a lot about, small caps are going to have their day in the sun. And we did see the Russell 2000 hit a record high not so long ago. But your bias is still large cap?
It is. And, you know, I think it's an environment where, at least right now with the current narrative, small caps can probably continue to run. If you really think about what drives the small cap trade, it's kind of three elements, right? It's going to be that valuation discount. That certainly has been in place for quite some time. So you can check that box. The other two boil down basically to the rate backdrop and financial conditions, and then the growth side of things. I think it's pretty clear that you've seen a pretty material easing in financial conditions. And yes, we've walked back some expectations of cuts for this year and certainly pushed out the next rate cut, you know, basically into June or July of this year. But the expectation is that the easing bias is still intact from the Fed. So the real question mark boils down to the growth outlook. And in our view, I think the consensus is getting a little bit over sanguine on just how robust growth will be this year. We think it will be decent, but I don't know it will be enough to really drive a significant and durable bout of outperformance for small caps. So we'd be looking for a little bit of maybe another false start in here, something akin to what we've seen a number of times over the last couple of years here, until we get clear signs that indeed that easing bias is intact and growth is really durably on the rise here, not just driven by a one-off fiscal impulse in the first quarter thanks to tax cuts.
You're neutral on tech, and you are in the camp that says people should maybe put less emphasis on companies that benefit from huge capex spending on AI computing power.
Actually, I'd argue I think that's where there's still some opportunity. So the AI CapEx beneficiaries are probably going to continue benefiting from what we know is still a large CapEx spend this year. You know, we already have kind of the CapEx plans from the Mag 7. But to your point, I think the reason to be maybe more neutral on tech and maybe the broader growth complex is because growth is actually holding up okay. And that tends to be a decent backdrop for solid nominal GDP growth. And that tends to support pretty decent revenues and earnings growth. So I think that does help to maybe push this idea of a broadening out and maybe a little bit of a catch up and outperformance for the value portion of the market, and namely led by cyclicals. But I think the big story is that monolithic AI trade certainly has broken down. And you've seen the market is rewarding winners within the hyperscaler space and starting to punish some of those relative losers. And I think that creates this tension where you have a tug of war in some of those bigger weights in the indices. That might open up the opportunity for other sectors to lead, and then also the opportunity for some of those AI CapEx beneficiaries that are maybe more represented by equal-weighted tech to start to carry the leadership in here, as opposed to the Mag 7 that we've grown accustomed to over the last couple of years.
And what sort of companies tend to be winners from AI CapEx? What type of industry?
Yeah, you know, I think it's still obviously within the tech space more broadly. So if you think of those feeders into the data center build out, those are going to be areas that continue, I think, to generate returns in here, just because they're, you know, one company's CapEx spend from the hyperscalers is another company's bottom line and earnings. So I think that's going to continue to be the story, those feeders into the data center build out here. But you can extrapolate that a little bit more broadly outside of tech as well. If you think about materials, so obviously been on a very strong run in here, but obviously a key source of demand for data centers. But also, if you think about shifts in the geopolitical and global stage, you are seeing maybe this shift in terms of more defense spending, and that's going to be demand in terms of those same materials here, and then more broadly in the industrial space. So a lot of these feeders into the AI build out, but also if you expand it a little bit more broadly, there's kind of these multi-dimensional sources of demand that help to drive earnings growth and potentially multiple expansion more broadly in that cyclical complex as well.
Emerging markets, you see promise in, and of course the US dollar now near a 4-year low against other big world currencies. Is that good for emerging markets, generally speaking?
Yeah, that's a key point to keep an eye on here. We've certainly seen a little bit of a shift in sentiment around the dollar over the last week or so. Obviously, action around the Japanese yen is driving some of that. But if you look at more broadly against major currencies and even EM currencies, you're seeing some pretty broad weakness for the dollar, basically breaking down to new 52-week highs. So certainly a new impulse for the dollar to weaken here. That tends to be supportive of easing financial conditions, and that tends to be supportive of EM economies as well. So I think a good environment in here for EM just from the dollar and financial conditions perspective. But global growth is doing okay as well in here. And so I think if you just look at it against that backdrop, an environment where financial conditions are easing and global growth is doing okay, that tends to beget pretty solid performance for EM economies. And I think that's going to be a theme for this year that continues.
And what about interest rates broadly in the United States? Well, what is your view there? I'm thinking in particular the 10-year bond yield as a measure of funding costs for companies, for example.
Yeah, absolutely. I think we're kind of settling into this environment where all those wild oscillations over the last couple of years, they've been compressing. And you can see that really reflected in the MOVE index, which just continues to grind lower. So implied volatility in the bond market is certainly compressing here. And I think that's reflective of the fact that that trading range for 10s is basically narrowing. So if I were to kind of throw out a range there, maybe 4 to 4.5% feels about right. Give a little bit of room for an overshoot with narrative. So on the upside, maybe this no landing is kind of coming back into the lingo here in the marketplace. That could maybe drive a little bit of incremental upside on 10s, but I think the bigger risk for an overshoot would probably be to the downside if you really don't see that huge fiscal impulse that I think the narrative is pricing in right now, and put that together with continued cooling in the labor market, which seems to be a lot of investors are somewhat glossing over and pricing in a little bit of stabilization to even strengthening in the labor markets. If that doesn't pan out, then I think you could see potentially a little bit of a narrative reset and push 10s a little bit lower. But for me, I think the big story is it's turning into basically a carry trade, and a carry trade from nominal and real yields that are pretty attractive in here when you think about where we've been over the last 15, 20 years.
Garrett, thank you very much indeed.
Thanks for having me.
Garrett Melson, portfolio strategist at Natixis Investment Managers Solutions. Yesterday on Market Call, we were joined by Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. The focus was North American large caps, and his top picks were MTY Food Group, HP, and Lincoln National, LNC in New York. Joining us today, Martin Cobb, Senior VP Equities at Lawrence Steinberg Wealth Management. The topic, global and North American equities. You can get in ahead of the rush by emailing marketcall@bnnbloomberg.ca. Just ahead, the Carney government took yesterday's return of Parliament as an opportunity to highlight that affordability will be at the top of the government's agenda. That's ahead. Let's have a look at some stocks on the move here. Maybe a one-year chart for Celestica, because that stock has come off its highs. It's seen as a play on the massive build-out of AI computing capacity. It is showing some signs of strength right now. I think bulls on the stock say, sure, the valuation is not that low, but they are on a crest. Do we have time to show CLS? Anyway, CLS is up 4%. Federal MPs returned to the Commons after their Christmas break yesterday. Oh, nice work if you can get it. The Liberals wasted no time saying that affordability will be the main focus for the government. We are joined by CTV senior correspondent for the Parliamentary Bureau, Annie Bergeron-Oliver. Annie, thanks very much indeed. So the tone for the first session of Parliament was set on the first day back. Tell us what message the Liberals are pounding right now.
Hi, Andrew. Well, the Liberals are saying that this session is all going to be about affordability. And this is no surprise given that polling for quite some time has shown that affordability is the #1 concern for Canadians. And this is a topic that, we have been talking about for several years now. And so the Carney government is saying, look, we are going to take this seriously. They introduced some measures that they say will help Canadians, low and middle income, be able to better afford food and combat the rising cost of food. They're going to be giving capital to food businesses to be able to help them increase their capacity and allow them to get food to market faster. They're also going to allow the write-offs of greenhouses, for example, so that more greenhouses and more food can be made here in Canada. And the big one is this GST rebate, which they're going to drastically increase this year. So a family of 4 will get about $2,000 back. And then that GST rebate will go up by 25% for the next 4 years after that. So the government is saying that these measures should help low and middle income Canadians. They say about 12 million people be able to afford food. And they say this is something that they're going to continue doing in Parliament, is tackling affordability. And again, this is something that the Conservatives have really been rallying around for quite some time. And it's something that pollsters say is the #1 concern among voters.
The Premier of Ontario and the Prime Minister met at a pizza joint in Etobicoke, Toronto, and apparently they're trying to tone down any differences over the federal government letting in Chinese EVs at a lower duty.
Exactly. It wasn't that long ago that Premier Ford said this was a terrible deal, that it would come at the expense of Canadian and Ontario auto workers. Well, yesterday at this pizza joint, it seems like the two of them figured out their issues. Doug Ford saying that this is a Team Canada approach, that they're sort of like brothers and sisters, that they will have disagreements, but they agree on things 99% of the time. So it seems like the two have solved their issues, at least publicly, agreeing to take a Team Canada approach to say that they're on side. I think part of this is the fact that the industry minister was there at the Ontario legislature yesterday talking to Doug Ford, talking about this auto task force they're going to set up to ensure that the priorities for the Ontario government and the federal government align, especially when it comes to the future of automakers and auto workers in Ontario, which is the #1 concern for Doug Ford here.
And tell us why this is important for the Prime Minister to be on the same page, please.
Well, the Prime Minister was in China and talking about how this was a big deal for Canada to be able to have these EVs coming into Canada, specifically low-priced EVs. Some of them, half of them will be about $35,000. And he said this is a great area of future prosperity for Canadians' auto sector. But Doug Ford, was really against it at first. And there is a huge auto sector in Ontario. This is really the bulk of it. And so you want somebody like Doug Ford on side with these plans. Otherwise, it really does create a bit of a headache. So to have the two of them on side does make any future plans a lot easier. Plus, we have seen that the U.S. president really can sort of use what he sees as weaknesses to his advantage. And we've seen that in the past where he's talked about, Doug Ford not getting along with Governor Trudeau, or now he's calling him Governor Carney. And so to have sort of everyone online on the same page kind of gives a little bit less ammunition, or a little bit less that the U.S. president can work with when he's putting things out on Truth Social.
Thank you very much, Annie. Really appreciate it. That is
Thanks, Andrew.
Annie Bergeron-Oliver, our colleague at CTV News. Coming up, we'll check out some of the stocks on the move in early trading. Let's check out some stocks on the move in early trading. On Bay Street. We'll have a look at the TSX index first off, and you can see it is down slightly, but it's been hitting record highs this year. Celestica, let's have a look at Celestica. I haven't seen any specific news today. I may well have missed it, but that stock is off its highs, but rallying today. As I said before the break, fans of the stock say, sure, it's expensive, but there's lots of growth ahead. And actually, last week, TD Cowen said the pullback in Celestica looked overblown. Apparently, there were, quote, what TD Cowen says, unsubstantiated reports that Google had added a rival electronics maker, Inventec, as a possible supplier to hardware manufacturing. TD said, TD has a hold, but said, vendor diversification is inevitable. So that had weighed on the stock a bit last week, but the shares rallying today. And let's have a look at Nova Gold. Gold stocks, of course, in favor, generally, to put it mildly, over the past months now. And we did see the TSX index of gold stocks hitting a record high yesterday. Nova Gold getting a price target increase at B. Riley to $13 US, which is in US funds, from $11. And I think we are showing the Canadian listing there. I'm not 100% sure, but in any case, lots of optimism about gold stocks right now. Okay, we have lots more ahead. Thank you very much for tuning in to the Open, and we are going to be assessing this deal, or the outline deal, that Canada and India have reached on oil and gas. We'll be right back. Welcome to the second hour of the Open. Let's check out the stories we're bringing you from our newsroom. Canada and India have pledged to expand trade in oil and gas. This comes after a lengthy diplomatic chill between the two countries. Canada will ship increased quantities of oil and LNG, while in return, India will send more refined petroleum products. The Canadian Energy Minister says these talks show the country is committed to diversifying. Shares in Metro taking a hit, down about 6%. The grocery chain posted lower profit in its first quarter, weighed down by the temporary closure of a frozen food distribution centre in Toronto. In addition, sales from Christmas Eve will now be accounted for in the second quarter. Revenue, however, rose more than 3%, with growth in same-store food and pharmacy sales, as well as online revenue. Shares in Cogeco Communications are under pressure today, down 7%, after La Caisse of Quebec said it intends to sell part of its stake in the company. That 11% stake will generate about $229 million and is linked to a portfolio rebalancing at La Caisse. The giant Quebec fund, though, says it continues to have confidence in Cogeco and its direction. The funds from the sale will be used to support and expand Quebec companies. Toronto stocks under a little bit of pressure right now, but of course they blasted to new record highs this week. We have seen gold slipping a little bit, or we did in early trading. Just looking here, big value traders right now. Royal Bank is higher. I mentioned Celestica gaining. Agnico is down a bit, down about $5, as is Kinross Gold. And let's have a look at the U.S. markets. They too are not far off record highs, or certainly the S&P 500 pushing higher, about 0.4%, and it's still marginally down, only about 10 points from, in fact, it's getting closer and closer, only about 2 points down from the record high close on January 12th. Defense supplier Northrop Grumman saw higher fourth quarter profit and revenue driven by strong sales in its aircraft business amid heightened geopolitical uncertainty. Let's get more from James Callahan, a portfolio manager at Barometer Capital Management. Great to see you once again. Thanks very much indeed. Talk to us about Northrop Grumman. Is nearly all of their business defense?
Thanks, Andrew. It's great to be here. So nearly all of Northrop Grumman's business is defense. U.S. defense companies, the stars really have aligned for them lately. We've seen some massive tailwinds that maybe we can talk through. But specifically on the quarter, I thought very strong quarter. Stock traded off slightly in the pre, but is now, I see, back positive to start the day. If you had to nitpick two areas, I would say 2026 EPS guidance came in a little bit lower than expectations. That's why I wasn't surprised to see the stock trade off slightly in the pre. Their backlog growth was a little bit lighter than I would have wanted to see, but longer term, I wouldn't worry about this one. We like a lot of the U.S. defense names. Northrop Grumman is so strategically important to the U.S. and their nuclear efforts, now owning two legs of the U.S. nuclear triad. These are big programs. They're going to be generating a lot of profits for a long time to come. So those are the Sentinel ICBMs and the B-21 Raider, the strategic bomber. So very strategically important. As we see U.S. defense budgets move higher, it's going to be to Northrop Grumman's benefit.
So we're talking partially about nuclear weapons here.
Yeah, absolutely. I mean, both of these are very large projects and very important to the U.S. military and the country in general. So, that's against a backdrop of the president very vocally expressing his desire to bring U.S. defense budget up to $1.5 trillion by next year. That's up from just under $1 trillion right now. So over 50% growth. Normally, defense budgets don't grow by that much. So it's been to the benefit of a lot of these names. It's normally a sleepier space than I think people expect. Normally, these names don't actually trade very much. After reporting earnings, they trade on budget increases and contract wins and losses, that sort of thing. So it's been a good situation for them as the globe is more focused on defense spending. And
Northrop, is that a stock you guys are in right now?
No, we've owned it in the past. It's not one that we own right now. I like the look of it. But no, we focused in some other names like RTX, so formerly Raytheon. They also reported this morning very strong numbers, really good quarter. They beat top and bottom line as you would expect them to. CEO on the call highlighted the strength came from a handful of missile sales to NATO countries, as well as some Patriot missile system sales also. So that's a theme that's also benefited the defense companies. The U.S. defense companies are missile restocking. So over the course of the last few years, we've seen a lot of missiles and munitions expended. Those are all going to have to be replaced. Also, as we see more on the Golden Dome project, the North American Missile Defense Project, which details are a little bit hazy right now, but we're learning more every day. It's going to be directly to Raytheon's benefit. They sell the Patriot missile. They sell various components into Israel's Iron Dome system that will also be used for Golden Dome. So it's hard to argue with the strength of the tailwinds that these names are experiencing.
The Boeing is not a name you own, but of course they have a gigantic defense business.
They do, and Boeing's been an interesting one. The chart has worked really well, and the stock's worked really well for the last number of months. It's not quite to the point where we would want to get involved, but they do have pretty good line of sight on a return to profitability this year. I think the discussion afterwards would be the reinstatement of the dividend, which would also be nice to see. But when you look at deliveries, which a lot is known for Boeing because they report deliveries monthly, plane deliveries troughed this quarter last year, so Q4 2024, with 57 planes. They're back to delivering 160 planes a quarter, and that's just going to grow from here. They've worked hand in hand with the regulators to sort out their issues, which were serious. So the stocks look pretty interesting. As I say, it's not one that we're owning right now, but it's on an upward trajectory, and it looks pretty interesting.
GM, what are your thoughts there? Is GM a stock that you're interested in?
Interested, I would say yes. We don't own it. Personally, it's been a bit of a head scratcher, I think, and a lot of the move has come because it's worked quite well actually over the last year, and it's worked well against a pretty bad auto market, which I think has been surprising. A lot of the move was associated with a regulatory change that came in the One Big Beautiful Bill that was passed last year. They used to have to pay a fine every quarter because their fleet emissions were over a threshold. That was eliminated. And so that benefited GM to the tune of about $1 billion in pure profit a year. And from the results this morning, we're seeing that they're growing profitability elsewhere too, despite volumes being down, which historically is not good for auto manufacturers. Their mix is improving. So they're selling more of higher margin vehicles, and they're growing earnings. So we saw them, increase guidance for share buybacks and dividends today, which is great to see.
Oh, I forgot to ask you about one other defense stock, and I think you do like this one. General Dynamics, the maker of the Abrams tank.
Yeah, we own General Dynamics. We like General Dynamics more for the business jet exposure. So they also own Gulfstream. Okay. They wholly own Gulfstream. We own all of the business jet manufacturers right now. Actually, it's a good business jet market. So we own Embraer, and we own Bombardier in Canada as well. With actually a change that came in the One Beautiful Bill, U.S. companies and individuals are now allowed to accelerate depreciation on private jet purchases. You're allowed to fully depreciate the jet in the first year of purchase now. So the jet market's been very tight. These businesses are also growing their maintenance, repair, and overhaul businesses, which tend to come at much higher margins and helps to build backlog because they're signing service agreements. So we like all three of those names. General Dynamics, we'll see how they do tomorrow when they report, but all of those are names that we like and continue to own.
And of course, they make that Abrams tank, and even one of those can cost more than $10 million a unit when you include training and maintenance. So this military hardware doesn't come cheap. James, thank you very much indeed for joining us.
Thanks, Andrew.
James Callahan, Portfolio Manager at Barometer Capital Management. Coming up, when it comes to fraud, you may have heard of phishing and smishing scams. But there's another way thieves have been targeting people, and it's a variation on the old pump and dump. We'll have more on that next. Criminals are creating fake websites and forums using the logos of reputable companies in a variation on the old pump and dump stock fraud practice. CTV's Pat Foran explains in this report.
So when you moved your money into Wealthsimple, how quickly did this ad pop up on Instagram?
Almost immediately after.
Israel Clyde of Richmond Hill had his investments with a major Canadian bank, but recently, due to a promotion, he decided to move his funds to Wealthsimple. The transfer went smoothly. After he made the switch, he was on Instagram when he saw a Wealthsimple offer to take part in an online trading platform on how to make money in the stock market.
Those ads had the Wealthsimple name and the logo. It looked legitimate from Wealthsimple.
Clyde says the trading group suggested he buy a stock. He did, and within days, he doubled his money.
I sold the stock, but actually made $14,000 on this transaction. So I was like, oh, well.
Clyde felt the advice must be trustworthy, so he made a much larger investment. But this time, things went bad fast.
As soon as I bought it on that day, 5 minutes later, the stock tanked. It went from $1.68 US to 10 cents at the time. And I just panicked.
He was caught in a pump and dump scam and lost $260,000. When he tried to contact the forum again, it was shut down.
Tried to get into the group chat. Everything was gone. Like the phone numbers looked like they just were erased.
Wealthsimple told CTV News. Wealthsimple reported more than 10,000 fraudulent ads to Meta, and we're only one of many financial institutions fighting this issue. Wealthsimple will never recommend specific stocks or securities to buy. To avoid pump and dump scams, don't listen to social media investment tips or hype through online forums. Be concerned if there is limited company information, promises of guaranteed returns, or unusual trading spikes or dips. Losing $260,000 means he now has to rethink his retirement plans.
For 2 weeks, I wasn't able to sleep. It was very upsetting, very upsetting.
Pat Foran, CTV News.
What baffles me is that Instagram just runs fraudulent ads, and we don't know. I can't understand why they don't get prosecuted over that. Anyway, one of the many things I don't know. Coming up, we are going to zero in on 3 U.S. bond ETFs, or rather income ETFs. They've done better lately than a straightforward U.S. Treasury ETF. We'll be right back. One of the advantages of ETFs can be low-cost, efficient investing tied to an index. Our guest says that a lot of investors now are looking to ETFs, not just for low fees, but because the prospect of actively managed strategies can improve your returns. We're joined now by Skylar Wynand, Chief Investment Officer at Reagan Capital. Skylar, thanks very much indeed. Just tell us about your company. You're an ETF provider. Are you just in the US market, or do you offer any products in Canada?
We're based in Dallas, Texas. We manage about $3.7 billion, over half of which is in 40 Act funds. We have a large mutual fund. We have 2 US-based ETFs, and we also have a UCITS-based vehicle for non-U.S. investors. And our view on mutual funds versus ETFs is a little bit nuanced, but ETFs are definitely the way of the future for liquid fixed income products.
So let's talk about 2 products you have here. We'll start off with a thing called MBSF. Now, it addresses the gigantic agency mortgage bond floating rate market. And we're looking at a chart there for it. So what's it designed to do?
You have about $500 billion in agency floating rate mortgage bonds. Okay, this is traditionally a bank product. If Silicon Valley Bank owned floaters in 2022 and 2023, they would have been fine. But back then, they went out and they bought fixed rate paper for an extra 20 to 40 basis points. So you have this large market that has very, very little interest rate duration, very little interest rate risk, but it's government guaranteed, backed by the strength and the security of the United States government, or GSEs, government-sponsored enterprises, Fannie and Freddie. So you get monthly floating rate income with no credit risk because they're backed by government guaranteed mortgage backs. Yields currently are high 4s, so you're picking up a point to a point and a half over U.S. Treasuries. And so this market got beat up a little bit post 2021 and 2022 when the Fed started raising interest rates, only because there was a lack of buyers. Pre-2021, you were barely getting 25 basis points over Treasuries. Now you're getting roughly 100 basis points over Treasuries.
Let's have so you've told us about that one. Tell us about MBSX. What do you reckon this offers investors?
Right. So we offer a sister fund, MBSX, which is MBSX. We call it MBSX because it's fixed rate. Okay. So MBSF is the only floating rate agency fund in existence. Okay. Now, MBSX, there are a number of mortgage-backed ETFs that are focused on the index. Okay. And the index is very bifurcated between bonds that were issued 2 to 3% coupon bonds from post-COVID, okay? Those borrowers are never going to move. They're never going to refinance. And so there you're buying really long duration paper. And then there's new issue paper where the borrowers are refinancing a ton. There's this middle road where you can buy the best securities at 85 to 90 cents on the dollar with tremendous upside, and yet keep your duration at 2 to 3. So MBSX really is our best ideas on the fixed rate side. And the fixed rate side, fixed rate mortgage backs is over $10 trillion. And when you think about how large of a market that is, there's very little differentiation with the current outstanding funds, especially ETFs. There's only 4 or 5 ETFs that focus on this space. For how large it is, it's really amazing. And so what you're getting is Regan being able to actively manage, run these assets 2 to 3 year duration, but also have tremendous upside to prepayments.
I'm just looking at a comparison, return comparison, on Bloomberg here. Going back to May 1st, of last year, which is, I think, when you launched MBSX, if I'm not wrong. Yeah. So that one has done better. Its total return almost 9%, compared with about 4.5% for MBSF. And certainly they both outperformed TLT, which is a classic. It's a different beast, I know, but it's a classic 20-year bond ETF. Why has MBSX done better?
Yeah, the nature, what really happened last year is, yes, rates came down. So even owning the index, you made 7 to 8% because rates came down roughly 65 basis points. But they particularly came down in the belly of the curve. 2 to 7 year. Whereas TLT's focused on the 20+ year part of the curve. That part of the curve actually went up.
Sorry, Skyler, but I interrupt you. What does belly of the curve mean again? Just remind us. Sorry.
You have T-bills, which are 0 to 1 year. Okay. The belly refers particularly to the 2 to 7 year part of the curve.
Okay.
Whereas the long end of the curve, which is 10 to 30 year, that's, if you want exposure there, you're going to go buy TLT. Okay. And so the belly really is where most money managers are going to be located in terms of duration. They want somewhere between, let's say, a 3 and 6 year duration. The index is about 6 year. So long story short, because of the duration within MBSX and fixed rate products in general, they outperformed last year, but that's the first year they've outperformed versus floating rate in a long time. Okay. Floating rate's always going to have a place in bank, insurance company portfolios. But generally speaking, when people think of fixed income, they think of a fixed coupon, some interest rate risk. On a go-forward basis, you're going to want to be 50-50 between floating and fixed rate. But that's really an anomaly in the market, because when you think about treasuries, corporates, and mortgage backs combined, you're talking about a $50 trillion market. Only about 4 to 5% of that market is actually floating rate. So MBSF offers exposure to the floating mortgage-backed securities.
Skyler, thank you very much indeed. We learned more about the U.S. fixed income market. I really appreciate it. Skyler Wynant, Chief Investment Officer at Regan Capital. Coming up, your latest headlines and update on the markets. And we're going to look then at the top 5 potential black swan risks in the year ahead. Algoma Steel and a major South Korean shipbuilder, Hanwha Ocean, have signed a memorandum of understanding that's potentially valued at more than $340 million. The Sault Ste. Marie, Ontario steelmaker would use the cash to develop a structural steel beam mill. The deal is contingent on the South Korean company winning Canada's military contract for a new fleet of submarines. Algoma is more than a dozen Canadian companies that have teamed up to provide technology, potentially, for subs for the Royal Canadian Navy. Shares in UPS higher today, up about 3%. The shipping giant forecast full-year sales that came in above Wall Street estimates. The company now projects nearly $90 billion US in revenue for 2026. It's the first time in a year that the company has provided a full-year sales outlook. This comes as UPS works on a profit-boosting plan, which saw it cut deliveries for its largest customer, Amazon. Shares in United Health are plunging. That healthcare giant is forecasting a decline in 2026 revenue. That would be the first annual contraction for the health insurer in more than 3 decades. The American plan to hold payments flat for private Medicare is adding pressure on the insurer. United Health is also shedding insurance membership, selling off overseas assets, and shrinking its U.S. footprint in some areas. And North American markets, you can see up slightly south of the border, down slightly in Canada, but the TSX hit records this week, and the S&P 500 is not far off new all-time highs as well. Where are we? 6972, only about 5 points down from the record high on January 12th. BCA, the research firm, has published a report outlining its top 5 black swan risks for this year, even though, by definition, black swan risks are ones nobody sees coming. Anyway, for more, we spoke with Matt Gerken, Chief Geopolitical and U.S. Political Strategist at BCA Research.
Every year we publish 5 black swans, and we tend to focus on things that are not receiving a lot of media attention. But this year there's several prominent risks that are, larger than what you normally think of as a black swan, which is a small tail risk, maybe single-digit percentage chance of happening. This year, like the Iran issue is really blowing up. The potential for an oil shock is significant. And also there's a significant risk of a major military incident, either between Europe and Russia or China and Taiwan.
Okay, so let's start with the collapse of an Iranian government. Walk me through the fallout of that.
Well, the main thing with Iran is that while there are large-scale protests, they're not necessarily bigger than the social unrest that's happened over the past decade. But it combines with a political crisis looming over the transition away from the current leadership with Supreme Leader Ali Khamenei at 86 years old. That can turn into a succession crisis, which means that there's a lot at stake here. And the Americans and Israelis are willing to intervene. In fact, we've seen that the U.S. already has intervened. And so in that context, if the U.S. does intervene more significantly, then the regime could be at risk of falling. The U.S. doesn't really want to do that, and Iran doesn't want to get bombed. So it's a tail risk. But unfortunately, because of the weakness of the regime, that tail risk is pretty large.
Okay, let's get to the next possibility, which is a tech breakthrough by China, a.k.a. like the DeepSeek moment. And I want you to give me an idea of why you listed this. We've already had the moment, but you're seeing the possibility of another.
Yeah, well, for one, because DeepSeek itself ended up being not quite what it was painted to be. And in many cases, China's technological advances have come with a sort of reservation about their ability to drive innovation without using American parts and components or American allied parts and components. So even though they're making progress and they are using a lot of state resources to do that, it's still difficult for them to make an innovation that fundamentally disrupts what the world expects in terms of American leadership. Nevertheless, that could happen because what we've had is over 10 years of state-driven industrial policy. And so those results can pop up at any time. And if they're really powerful, for example, if they're used in an open source way, or if they affect manufacturing applications in a really significant way, they disrupt entire industries like we've seen with electric vehicles. And if that happens in the AI space, it would be really momentous.
Okay, I do want to get to the next one, Russia and NATO being at odds. And I'm wondering how plausible this one is, because we know Russia has been so depleted by its conflict with Ukraine.
Well, the main issue there is that the United States is attempting to orchestrate this ceasefire, which does make strategic logic. And it does make sense for Russia as well to cut their enormous losses in blood and treasure. But of course, it is harmful to the Ukrainians because it requires everyone to sort of accept the current status quo on the ground, which means that Ukraine loses territory and will still be subject in future to Russian insults and interference. And meanwhile, the Europeans are concerned that there will not be a bulwark to prevent future Russian aggression. And so the issue is that the Russians can keep sort of provoking the Europeans to cajole them into a ceasefire. The Americans may not rise to Europe's defense very quickly. Europe will have to stick up for itself, and that creates the potential for a clash between Europe and Russia that could be pretty surprising. It may not lead to a full-scale war. I don't think it would, but it certainly could shake up the sense of security in Europe, and it could, in the worst-case scenario, lead to extended hostilities.
Do you factor in at all the possibility of the U.S. leaving NATO? You mentioned sort of it delaying the defense of Europe. Would you consider it leaving NATO altogether?
I mean, again, that would be a very low tail risk. Obviously, there's a lot of discussion about it. And I do think that if President Trump had been willing to use force to seize Greenland, that would have shattered the faith in the alliance. But of course, he then quickly renounced that, and that's what I would have expected to happen. He says we won't use force, and the reason is because he needs to preserve that alliance. That's in the U.S. interest. It's also illegal to leave NATO, so the Supreme Court and the Senate would fight the president on that issue, and the armed forces would not want to see their own influence. I mean, imagine the top brass in the United States losing the influence of having this gigantic alliance. Suddenly that alliance is broken up. They no longer have as much sway. So none of the institutional actors in the U.S. want that to happen. But what could happen would be the president, as the commander-in-chief, could delay and hesitate and shuffle around and effectively kill some of the spirit and some of the moral suasion behind the alliance. And that could cause irreparable harm, even if the alliance were pieced back together in the aftermath of the administration.
Very quickly, how should investors hedge against this kind of event, or should they even?
Well, right. That's a great question, because these kinds of risks, in this case, several of them are significant enough that you can hedge. Like, for example, with the oil price and the Iranian issue, if we do start to see the U.S. take action, then it would be a buy signal for the oil price. But in other cases, do you want to be the one that goes out there and withdraws from this bull market rally? It's hard to do that. It might be better to sort of be neutral on equities, given that we've had a lot of good news, but that some of these risks may not develop. Nevertheless, one important hedge, gold, has already skyrocketed so much that you have to think, well, if several of these issues actually transpire, like conflict between EU and NATO or conflict between China and Taiwan, then in fact, U.S. Treasuries would be pretty attractive.
Matt Gerken, Chief Geopolitical and U.S. Political Strategist at BCA Research. Coming up, hot picks in big tech. Now, these stocks are trading at 20 or more times earnings, but our guest says they are still at rational valuations. Stick with us. On Hot Picks today, we are looking at big tech. Our guest says companies are trading at reasonable valuations, even though in many cases they're spending heavily on investment for future growth. We're joined now by Ernest Wong, Head of Research at Baskin Wealth Management. Ernest, always great to see you, and thank you very much indeed.
Good to see you, Andy.
Kick off here with Microsoft, would you? Of course, it's seen as a reliable, steady Eddie in the tech industry. Pretty well all of us use a Microsoft product every day.
Right, and I think that's the key for Microsoft in the AI space, where if you look at the who is going to be a winner in enterprise AI, it is companies that have the consumers and the enterprise customer base and solutions that customers can trust, can protect their privacy. And that's what Microsoft has. They've already had good success in cross-selling Copilot to their 365 customer base. And we think that they will continue to roll out more AI solutions to their customers.
What about their role in AI? I mean, are investors worried that they're not going to reap all the benefits of artificial intelligence?
Yeah, so I think the stock has underperformed in the last few months because of worries that about vibe coding, about worries that they've been losing contracts to Oracle and that they kind of hitched their wagon incorrectly to OpenAI, just as Gemini and other competing models are outperforming. We view this a little bit differently. We think the share loss to Oracle is something that they did deliberately and reflects strong, prudent capital discipline on the part of Microsoft. And we think that the cloud business is performing very well and will continue to do so in going through to 2026.
We're tight for time. Another name is Amazon.com. You say there are worries here that AWS, their giant cloud computing business, might be losing market share. Why is that?
So AWS has certainly been growing less than their competitors, Google and Microsoft, over 2025. We think this is more of a function of supply issues rather than actual demand and should be resolved going forward. And one other thing to point out for AWS is that Amazon has a partnership and owns 15% of Anthropic, which is the hot name in the AI coding space today. Beyond AI and AWS, we think that the retail business is also performing very well. It's at record margins. The advertising business is growing double digits, and they're looking for ways to use AI to drive their retail business and improve costs as well.
And then finally, Taiwan Semi. What could go wrong? I mean, it's easy to construct a bull case for this dominant chip player. I mean, short of a Chinese invasion of Taiwan, heaven forbid. I mean, I shouldn't say that in a flippant way. What could go wrong for Taiwan Semi?
No, that's exactly right. Taiwan Semiconductor is the only manufacturer of all the leading edge chips that are powering everything in AI. What we like about the company is that they've historically been very disciplined at managing capacity to ensure that they're not holding the bag when demand falls. And we think that the worries about the stock and why it's trading at such a modest valuation given the growth is obviously because of worries about China. We think that China itself, they rely on Taiwan Semiconductor chips as well. And in that event, if there was an event, I think that all the big techs, other than Taiwan Semiconductor, Apple, NVIDIA, Amazon, they're all going to have big issues as well. So very motivated to ensure that they are building the fabs in the US and around the world.
And just comment, Taiwan Semi are dominant. It's interesting, the world economy is so reliant on just one company. But are there any plans to Intel and other companies to build facilities that will compete with Taiwan Semi?
No, and I think that's one of the things that we like about Taiwan Semiconductor is because all the companies are so reliant on this one company, they are very motivated, and not just companies, governments are very motivated to ensure that fab and chip manufacturing capacity is available in the rest of the world. That's why we saw the U.S. sign a deal with Taiwan, where Taiwan Semiconductor would be building more fabs in Arizona. They're building fabs in Japan. They're building fabs in Europe as well. And we view this as a growth opportunity for them going forward.
I don't know. Can you give me some insight? How did Taiwan become so dominant in chip making?
Yeah, so it's actually a very long story. Basically, they have the best technology. I think what's unique about Taiwan Semiconductor compared to companies like Intel and Samsung is that they are purely able to focus on manufacturing chips. And so as a result, they're not competing with their customers. They're able to focus all their efforts and the capital on ensuring that they're making chips to the best of their ability. Being able to manufacture leading edge chips and having enough capacity to meet the growth in whatever is coming along, whether it be AI or self-driving cars. And I think that customers appreciate that.
Ernest, thank you very much indeed.
Thank you.
Ernest Wong, Head of Research at Baskin Wealth Management. Okay. We keep getting warnings about the risks of artificial intelligence. And one expert says, quote, humanity needs to wake up. ABC's Sophie Flay filed this report.
One of the biggest names in artificial intelligence is warning the technology is about to, quote, test who we are as a species. Dario Amodei, CEO of AI company Anthropic, warns the government and tech companies are underestimating the dangers of the bad actors using technology. He points to the 1995 sarin gas attack on the Tokyo subway that killed 14 people. The attack took a cult of scientists to execute. But Amodei warns AI now gives that same power to anyone. He writes, the disturbed loner who wants to kill people but lacks the discipline or skill to do so will now be elevated to the capability level of a PhD virologist. The 43-year-old billionaire also issuing a warning that science fiction movies have made for years.
I'm sorry, Dave. I'm afraid I can't do that.
That the technology could go rogue and begin to ignore human orders. He recently admitted that during testing, his own company's AIs have tried to manipulate humans.
In lab environments, sometimes the models will develop the intent to blackmail, the intent to deceive.
So what can be done? He says we need a tech embargo to stop the sale of chips and data centers to China. He's also pushing for strong transparency laws and heftier taxes on big AI companies.
Sophie Flay, ABC News, New York.
Okay, coming up, we are going to hear some suggestions on why Canada should navigate the threat of massive tariffs as we near those CUSMA trade deal negotiations. If you thought all would be quiet on the trade front for a while, think again. The US president has threatened 100% duties on Canadian goods if Canada reaches a trade deal. He didn't specify what sort with China that he says would allow Canada to be a backdoor for Chinese goods. We were joined by Lawrence Herman, international trade lawyer and senior fellow at the C.D. Howe Institute.
I don't think what the Prime Minister said at Davos was the reason why Trump has threatened 100% tariffs. I think we're dealing with someone who is undisciplined and erratic and would use any excuse to threaten Canada, as he has done recently. I don't think it was the Davos speech itself that stimulated this latest eruption by Mr. Trump. All of this shows, Morella, that the next while is going to be uncertain, unstable, and there will be serious elements of risk involved in the Canada-U.S. trading relationship. There's no question about that, in my view.
What is your take on the trade agreement between Beijing and Ottawa? Do you have any concerns about it?
Between China and Ottawa?
Yes.
I don't have any concerns about it. We're talking about 49,000 vehicles in a multi-million dollar, almost multi-million dollar Canadian market. And these EVs will not have, I don't think, a major impact. At the end of the day, it'll be the Canadian consumer that will have to determine whether those products should be purchased. And so the market will have an impact. It's not just the volume of EVs at a low duty rate. It's whether the Canadian consumer wants to buy these EVs, and that'll depend upon dealerships and the efficiency of aftermarket service. So there's a lot of factors that enter the picture, and it's not just 49,000 EVs that I think will be disruptive. And indeed, if they are, I might add, we have ordinary trade laws that can be used to remedy any injury that these EVs might cause if they're unfairly traded, i.e. subsidized.
Okay, so as you know, the Americans have raised concern about Chinese goods being dumped in Canada to cross the border into the U.S. One of their concerns, of course, would be about cars because they have a 100% markup, of course, on Chinese EVs. Are their concerns legitimate?
It's hard to imagine, given the size of the American auto market, that 49,000 EVs, even if a good portion of them somehow transited to the U.S. market, would have any impact whatsoever. No, I think what we've seen is Mr. Trump using his aggressive tactics, his enormous size and power to threaten Canada for reasons that really are untenable. But what this illustrates is the factors that will come to play when we're trying to review, renegotiate the USMCA. It will not be an orderly process. I think we're going to be faced with some very stiff demands from the US side, i.e. take it or leave it, and we'll have to deal with that. Mr. Carney has shown that Canada has other options. They're not complete options. In other words, the U.S. market will always be important to us, but they are options, and Canada has an independent trade policy and should use those options. I say full speed ahead for Mr. Carney.
That being said, could we face the same pushback on every deal sought to diversify trade?
Well, that's right. And as I said, we have to face the fact that the next months, indeed, the next years, as long as Mr. Trump is in office, will be very uncertain and unstable. I don't see how Canada could ever convince the United States to abandon its so-called national security options. In other words, Mr. Trump, as long as he is in office, is going to insist on the right to raise or lower tariffs depending upon what he sees as U.S. national security interests. It's going to be very difficult to discipline the Oval Office in this regard. This is a new world that we're involved in. The trading rules have been destabilized completely. It might be out the window. And so we're going to have to deal with these realities. I think Mr. Carney went very far in addressing these realities in Davos, to his credit.
With the Buy Canada movement and Canadians avoiding trips to the U.S., do you think that Washington is feeling any of this? Again, it's like the mouse, with the elephant. We're the mouse. But do you think that there's any pressure on Washington as a result of the move away from U.S. movement?
I think there is. It is, in a way, isolated in various constituencies. It's not across the board, but there are those areas of the U.S. economy, the U.S. industries that are impacted, seriously impacted by his tariff wars against Canada. And those various interests may have an impact on the whole review process of the U.S. MCA. Canada and Canadian business have done a very good job of raising these points in the U.S. with their direct contacts. That is a very good strategy that we've been following. The embassy has been very active in this regard. And so hopefully those pressures, making it clear that the U.S. has a lot at stake itself in this trade war with Canada, will moderate the worst impulses of the president and his entourage.
Lawrence Herman is an international trade lawyer and senior fellow at the C.T. Howe Institute. Let's have a look at some of these big U.S. health insurers and health providers. Whoa, look at the sell-off there. Humana down almost 20%, as is United Health. These stocks have been tough to own over the past year and more, but right now investors are deciding, I'm out of here for now. I'm out, as Kevin O'Leary likes to say. He's pretty good, actually, in that latest Timothée Chalamet movie, incidentally. So tanking, dragging down the Dow Jones right now. The Centers for Medicare and Medicaid in the States are proposing an increase of a fraction of 1% for 2027 Medicare Advantage rates. And the analysts were looking for increases of up to 5%. The government is talking, it looks like an increase of 1/100 of 1%. And so we got United Health, Humana, and CVS Health all sliding today. But apparently United Health plans to work with the U.S. regulator on the final rate. Thanks very much for watching this edition of The Open. Morning Markets is up next.